morning all. Sure we're all enjoying having digest another week's worth of information in a short period of time and continue to adjust our approach to the world. Now 3 sort of weeks since a reasonable shutdown and a month for some more of us like we have been, where we've been split teams. So the aim of today is to provide a general update on a few of the specific issues and go through a lot of the things that have moved over the last week, particularly around JobKeeper and bank funding. So I'll do a quick overview of where things are moving around from what we see in risk, and then hand over to James and then into Mariana as we go. So without further ado, I'll jump into it. So we've been working with a few of our clients and a lot of our contacts around understanding what information they need to get together to understand what their forecast looks like. JobKeepers obviously clarified that a bit, that people are really looking at their numbers, seeing what they can do to pay their employees and what the impact would be of JobKeeper, which is obviously only $39,000 a year paying people when people are on obviously more money than that. So what portion they're paying people over the top and how that is working with their business. So that's creating a lot of change and a lot of consideration. The major thing is understanding where people are at and what impact has happened and what is expected to occur from this, because that will be something that needs to be explained at some stage, probably to your bank, and also for those who are subject to audit, it's going to be an issue for audit coming up for 30 June. And then obviously that will also help understand what impact will be in 2021, although that is a much more of a guessing game compared to a few of the other things. The next thing that boils out of understanding the starting position is then talking about the cost to continue. And a lot of the work we've been doing the last week is looking at base costs and how that can be adjusted or triggered to become a little bit more variable rather than being fixed, and any other costs that sort of run with that. So the base costs we looked at are base rent and base wages. Obviously, a lot of administration costs are probably coming down because people are just not in the office or not incurring those, but other variable costs are changing as well as they go through, because people are just not traveling as much. There's not as much entertainment and other things. So there's been a real reset in a lot of those cost bases. And all of that leads back to then looking at the funding options and how you actually utilise the government stimulus coming through, the bank funding that you can access, the 250,000, and then for the larger entities and some other entities which have different structures that they're going through and looking for expansion funding is non-bank funding, and looking at how that fits together. The other thing we're looking at for non-bank funding for a few of our clients is for acquisitions, because people are looking at this as an opportunity to be able to do the things that they couldn't do previously because competitors or other parties were willing to actually continue to trade. Now there's a bit of realism that's coming through that is making people willing to consider alternatives which previously were not even on the table. So there's a little bit of funding going around for that. There is money around. It's at a fairly aggressive rate, aside from the bank funding, which is also there, and James can talk to that. But getting bank funding at the moment there's a timing difference here, and there's also a requirement to submit the normal information, and whereas other parties are willing to take a bit more of a ride, and you obviously pay for that. If there are any concerns that boil out of all of those issues, then we suggest a safe harbour review, and we're getting a few of those done for some clients and some referrals that have come through. That just sort of really goes through and stress tests the forecast and the options and gives the directors some safety around what they need and how they can actually execute their plans. It creates an extra layer, because although insolvent trading has been suspended for 6 months, the director's duties are still there and their responsibilities are still there to make sure that the strategy that you are implementing is the best outcome. And then beyond that, consider options and monitor. Everything is moving around on a sort of a Tuesday and a Thursday when the government makes an announcement, and it adjusts each of the tweaks, and then the state government makes an announcement and that adjusts each of the tweaks, and people are still sort of responding to the Tuesday, and then the Thursday kicks over the top. So we're hopeful over the next sort of 10 days, as things seem to have calmed down, that there is a bit more balance and people can actually start to spend the time they need to really get into, okay, what does this all mean and how does it all figure out? Because that will start to help people get more comfortable about where they're going. And we've got a poll question in there, which helps everybody understand, because a lot of people are coming to us and saying, well, am I eligible? How does this all work? And that's one of the big issues that we're driving going forward, is to try and help make sure that everybody who is entitled gets access to all of the stimulus they can. In terms of the other value things that we're seeing and the things that are actually making a difference at the moment, obviously the big thing is around making sure that cash is retained. And we talked about this last week in the ones that we went through in the webinar last week. Cash accounting for GST. We've made a number of requests to the ATO for a payment arrangement just so that GST will be paid when received. And the other thing that we've also been looking at is bad debt adjustment. If there is going to be 6 months payment on some GST, whether that is looked at as a way to preserve cash, because the worst outcome for any business is to have to pay for GST that it hasn't actually received and pass that on to the government. So protecting that position is a great way to actually improve your cash flow in the short term and not actually create a longer term liability as well. Now, we talked about last week that there is some stand down, there is some implications from stand down, which means it may not be the best option for certain businesses. We're not lawyers, but there is, you need to get advice around that specifically, because there could be other ways to do and have the same effect, which doesn't create problems or issues down the track. So each of those things need to be considered carefully and go through the normal process, which I'm sure everybody's going through because it's a major change to change your workforce. But just get the right advice to make sure that you're considering all the options available and have the mature conversations with your employees, because we've had it with our employees, and everybody is more accepting of things at the moment because they understand that this is a time of change and things are going to vary. Security for related party funding. This is another thing that we see as important coming out the other side. Money that's going in to fund businesses for the short term and secure them through this process will also help people come out the other side if there is an issue or a restructure or discussions with the bank. This gets them a seat at the table, because they cannot have a transaction occur without them being involved, because they have the secured position, and it gives them an ability to be able to participate in anything that happens going forward, even if the worst does occur. And then the hibernation and spring plan. We had a conversation internally ourselves this morning about what our plan is to return if all of our staff are allowed back into the office, and how that would work, and how you would operate with long-term social distancing, particularly when you're working cubicles or where you've got to travel into the office via public transport. Nobody has really got their head around how that's going to work, but now is the time to start thinking about that once you've got everything else under control, because the person who I suspect who does that the best will obviously maximise the impact. So that's just some of the things that we're seeing in the market. I'll hand over to James, who's more important because he can get you cash. And that's the primary thing for people at the moment.
Thanks, Todd, and welcome to everyone. James McFarlane, just a little bit of background on myself before I go and cover what the banks are currently doing. I had 25 years banking experience, ran corporate banking businesses for about half of that time, mostly with St George Bank, and 3.5 years ago set up HLB Debt Advisory and have helped many businesses and individuals secure funding, in fact up to about $500 million worth of transactions. So come well experienced, and we are certainly in very interesting times, and I am dealing with the banks quite regularly at the moment. And as Todd mentioned, it's very important for businesses and business owners to work through what their plans are, not only in getting through the next couple of months, but also hopefully kickstarting the business or going through that start phase again. So whatever that plan is, and if that plan needs money and part of that money solution is debt, well, that's where I can help, and I'm here to help. So please do not hesitate to get in touch. What I'm seeing is that banks are doing things outside of what they would normally do. Just to give you some examples of some customers that I've been helping in the last very little while. I've been helping a lot of businesses, particularly those that are borrowing more than $1 million, to either extend facility maturity dates, have interest waived for up to 6 months, and that's not just the principal repayments, but also the interest payments being waived or deferred for a 6-month period. I've also been helping smaller businesses access the government-backed $250,000 loan. And I've had some of my longer-standing clients who are very well funded historically, but prior to this COVID experience, and some of them have brought me 5 or 6 of their industrial businesses to put working capital lines in place, because they do expect that their debtors will be paying them a lot slower. They expect that some of their debtors might actually not survive the next 3 to 6 months. So for 5 of their businesses, and these are all businesses that turn over in excess of $100 million, I'm getting debtor finance facilities in place. And really that's just to ensure that they've got sufficient cash for the next 6 to 12 months to manage the situation. And these are very experienced industrial business operators. So if they're doing this sort of stuff, then everyone needs to have a think about this. I'm also doing some recapitalizations, so where the equity structure needs more cash, and then some of the equity holders are borrowing more money to take a greater equity position to get the business through this phase. And we're advising together with people like Todd on how best to do that. I'll now just run through Tenure, just go through to the first slide. Just what this is what's sort of been published, either through the press, or I'm sure you've probably seen things from your own existing banks at this stage. All of the major banks and most of the regional banks and a couple of non-banks have been approved by government to provide these government-backed loans of up to $250,000. There are some restrictions around it in that businesses need to turn over $50 million or less to be able to apply for this loan. They also need to have been impacted by the situation we're in. And the loans themselves are up to 3 years. The first 6 months is no payment of interest and no payment of principal. But then after 6 months, the loan is fully amortized over that remaining 2.5 years. So whilst there is a 6-month holiday, you will find that you will need to repay the loan within 3 years and have the cash flow to be able to do that. Now, if your requirement is certainly above $250,000, then banks will consider further amounts. So one loan might be up to $250,000 considered in this structure, and then you can apply for other loans over and above that, but they would be under normal banking terms and requirements, normal banking security. Whilst banks are fairly stringent on their servicing assessment, they are a little bit more relaxed in the current environment around how they assess servicing. But needless to say that the bank has to be convinced that the loan can, whether it's the $250,000 or even more, can be repaid. Just for information purposes, half of that loan is actually guaranteed by the government, which has allowed them to offer these unsecured loans at reasonable interest rates. Most banks are offering these loans at around 4.5%. The other things that banks are doing for small, medium-sized businesses is they are being more negotiable around certainly their cash or overdraft type funding facilities that you may already have in place. I've certainly seen them reduce rates on these sorts of loans by anywhere from 1 to 1.5%. They are quite reasonable about extending maturities, whether it be for cash loans, equipment finance loans. In fact, the CBA or Commonwealth Bank pretty much wrote to all of their existing clients for any loan up to $1 million, and it was an opt-out situation. So if you didn't want the extension for 3 months, so with the deferrals for interest and principal for 3 months, you had to write to the Commonwealth Bank, otherwise they just did it for you. So that's an example of one action taken by one of the majors. They're also being more negotiable around other fees and things like their merchants and other things which you can actually negotiate. So do not hesitate to get my advice. Get in touch with your bank, talk to them, particularly if you've got someone you can talk to, and see what you can do in terms of getting some waivers or fee reductions. Next slide, Tanya. They're obviously also helping personal customers. My colleague here, Betty Preshaw, does a lot of the personal financing here on a brokery type style. And they're helping all banks and all mortgage funders have pretty much come out with their own policies. But in the main, and supported by government, they've allowing a 3-month deferral and then up to a further 3 months after that. The government wants them to check in with customers after 3 months to make sure that the deferral is required for a further 3 months, but basically up to 6 months deferral. And that's principal as well as interest deferrals. Some of the banks are actually offering really quite reasonable term deposit rates for longer terms, just an example there. And they're also offering, most majors and regionals are offering quite low fixed rates at the moment for say 2 or 3 years, and in the low 2%. So there are deals being offered, so they're definitely worth being considered at this point in time.
So JobKeeper is something we've all wanted to know about. The main thing to be aware of, I'll just give you a big overview, is that the rules and the explanatory statement have come out. So what happened last week, Wednesday, was the legislation got passed, but it was a framework, and that went through Parliament. But over the Easter break, I think probably Monday or yesterday, who knows when things come out because they don't tell you, they just pop up somewhere on the Treasury website. So if you go to treasury.gov.au and you type in JobKeeper, at the end of that, you'll find the rules and the explanatory statement, which happy for you to look at any point in time. Also, what's come out is if you go to the ATO website and you type in JobKeeper, it tells you how to actually elect and all the information that you need to know about being an eligible employer, nominations that you make for eligible employees, and etc. So I'll run through that in a bit more detail at the end of this. The big thing to note is that if you're eligible from the beginning, employers get $1,500 per employee every fortnight effectively to be paid in a month in arrears. So the first payment would be May for the month of April. So in total, you'd get $3,000 effectively for one employee. And then it'll be beginning of June, beginning of July, every month after that. So if you have one employee from 30th of March, 27th of September, you've had these decrease in income. So we'll go through that. So that's 13 fortnights. That's $1,500. So that's $19,500 you get per employee. So it's a substantial amount. So you multiply 19,500 by a number of employees. It's a good amount. And the purpose of it is it's really to supplement your cash flow. So to identify that the first payment is going to be in May. So that means for April, you will need funding to pay your April salaries. That's when James can come in handy. You can go and talk to him about those $250,000 loan. You might have an overdraft you're using, whatever tactic it takes. But after that, you'll get a payment every month. And that has to be passed on to the employees. So now to the nitty-gritty. So who's the eligible employer? So you must be carrying on a business on 1 March. All right, for that hopefully is everyone here on this call. And if you're not a business, you're a registered charity. Now, we were discussing about, okay, what goes next? What is the aggregated turnover of a business? So if your aggregated turnover of business is less than 1 billion, now in most cases you're saying that's no problem, we're well under $1 billion, then you have to show that you've suffered a decrease of more than 30% or more in your income for a month or for a quarter. And I'll go through that in a minute. Now back to the aggregated turnover, what is that? That is a term tax uses quite a bit. A lot of you on the call would be under the billion, but if you are over $1 billion, you will know because you'll be a significant global entity which completes a country by country report. Now, if that means nothing to you, you're definitely not one of those. But if you're under $1 billion, then it's the 30% or more. Now, if you're over $1 billion, that means that the employer the turnover has to come under, over 50 and over. So that's a big drop percentage. Now, what's the reasoning for the difference between the 30 and the 50? The reasoning is that in most cases, this is assisting employers to maintain their staff. And in some cases where staff have been stood down, this is a bit like a Centrelink. So the employer is acting like the payer of the employment benefits, if you like, for the unemployment benefits, if you like. But if they're effectively receiving salaries, then this is just a supplementary cash flow in and out. Now, the logic of the over $1 billion is that if you're over $1 billion, you've got a global network and potentially your parent entity can assist you. That's not always the case because I'm sure the parent's helping every sub. All right, so when we said you look at the turnover, so you've said aggregated turnover, you've come up under $1 billion, and then you must have suffered a decrease in turnover, group sales, for a month. You have a choice of either choosing a month in the year or a quarter in the year. So what does a month mean? A month means you could be April to September months. Now, it actually says in the rules that it can actually be March as well, which is interesting. So that means you could use March 2020 and you compare it to your actual March 2019. And I'll run through an alternative test if you didn't exist back in March 2019, or if you, for some reason, have seasonal income and that month would not be the right comparative. So you can choose a month or you can choose a quarter. So really, I would do the test for both. So if you're choosing, say, April as a projected turnover, and it is projected, it's based on the GST turnover, then I would go through and identify for the month of March, compare it to 2019, and also maybe project 2020 April. What do you think your turnover is going to be? And compare it to April 2019. And I'd also project what it would look like if you looked at a quarter instead. So if you looked at April to June as being your first quarter, what does a projection look like? And I'll go through what that means in a bit more detail in the projection. But the thing to note here is that you can choose either method, but once you meet the eligibility test, that means once your turnover goes down by 30% or more or 50% or more, depending which one you are. Now, not-for-profits, it's 15%, but we have a separate session for that tomorrow at 9 a.m. So I'm not going to run through that in any great detail. But one thing to be aware of is once you meet the criteria, you're in. So, from a comparative test, once you've done the test and you meet it, so the sooner you meet it, the better. That means you start getting the payment every May, June, etc. for 6 months. Now, you don't have to retest, but you still have reporting obligations. And the ATO is saying those reporting obligations as to what your turnover is going forward is really for them to identify with COVID-19 the effects to the economy. That's what they're saying. Look, these rules are fairly complicated. I'm just trying to simplify it, and there is a lot more detail, and happy to chat to you about them. Now, as I was saying, you've got a comparative. How does the decline in turnover work? To be eligible for the JobKeeper, the employer must show that it suffered a decline in the projected turnover. So in a calendar month, as I've indicated, starting from March to September, and in a quarter, starting from either 1 April quarter or 1 July. So why am I giving you all these alternatives when you only have to do the test once? Or understand if you've met the test, the turnover test once. The reality is that some organisations may not meet it for April. They may not meet it for the April and June quarter. So they would test again in the May quarter, at the beginning of May. And again, it's on projected income. And I'll go through that in a minute. So, so long as you've had that decline of equals 30% or greater, compared to the actual of the last year, you'd be eligible. And with the other criteria if you're carrying on a business and so on. So you can choose, again, whether you're monthly or quarterly, whether you come within the test. Now, projected turnover is an estimate of the gross revenue by the employer on the balance of probability, because remember, it's projections. Now, we all know what a month may look like in real life, but with COVID-19, do we really know what a month looks like? Well, we've already gone through March, so we definitely know what March looks like. Is April going to follow suit? So we may have already met it in March and we go no further. If we're not 100% sure, then we'll need to test for April and we'll make some projections based on what's been happening in March and what's been happening in your business, how it's been affected. And it must be based on a reasonable estimate of your sales for the month ahead. So again, it's projection. So it would be expected that the employer would be able to substantiate the projection turnover report. So again, can you substantiate your report, your turnover? And that's conversations we can help you with. So once you qualify for the month of the quarter going forward, regardless of your turnover going forward in the subsequent months, you meet the criteria and you're up for JobKeeper. So some examples, because I always think examples are a good way to show it. So what happens if your turnover tends to be greater than the 30%? So it's 30 and more. Well, you've probably got no problem there. So an employer estimates the projected turnover, say in April, and maybe they've projected for the quarter of June as well. Maybe they've done both, and they find that they've projected it was 35%, but it ended up being 40. That's fine. You're over 30. So that means there's no requirement to meet the turnover test again. You're in. And I'm sure there's more to come on this because that won't be the end of it. And the other bit was, say for example, you estimate your turnover, but you're well under. You say 20% instead of 30, not even near the mark. Then you have to effectively, the ATO is saying, well, likely saying that you'll have to repay the money. There's more information to come out on that by the ATO. They accept a margin of error, say it's 29.5%, but 20%, that would mean that you'd likely have to pay it back if you projected that it was going to be well under, and for whatever reason, it wasn't the case. Another scenario might be that same facts as above, you don't think the June quarter turnover will decline by 30%. However, likely your turnover in July will decline by 30%, or a month of May, depending on how you're assessing it. So you may not get it for April, but as I mentioned before, you may get it for May. So once you start getting it in a period or a month, you then going forward, you get it every month after that. You don't backdate, it'll only start from the time that you qualify. I'm just going to go through, so that's probably a good example of the ordinary test, if you like. There is an alternative test. If there is no comparison in the prior year, potentially if you're a startup, if you're a seasonal business, or maybe there's been a restructure happen. So there's many reasons why you might not have a comparative. Now, just one thing to note is if you do have a comparative for the prior year and none of these, you're not in a certain criteria that I've mentioned, you can't apply the alternative test because it might suit you. So just to be careful about that. And they've got some examples in the explanatory statement. So they've indicated if you're, say, a startup and you started in October of 2019 and you're assessing April. So you've got your projected turnover for April and you think, oh, well, I haven't got a comparative for April 2019. What's an example the ATO has said is that what could be used is get the period you started, October to March, take an average of what the turnover was in that month and compare it to the April 2020 period. Has there been a drop of 30% or more? Okay, so that's an example. But again, more to come on that. So watch this space. So I guess for your action point is make sure that your figures are up to date. You've got all your comparative figures and you've got all your current figures. Another question's been asked at times is, could I defer my invoices? Because as Todd was saying, it's based on GST projections. So, a lot of these figures were taken off the BAS, G1 from sales. Now, I know G1 includes input tax supplies, and my understanding is the projected GST turnover is only on sales and GST-free sales, so it doesn't include input tax. Effectively, can you defer invoices for April into May to get your turnover down so then you can meet the criteria? I just think you have to be very careful. There's some strong anti-avoidance rules in this legislation. So if people are trying to be sneaky or smart, they're going to come at you with large penalties, interest, and repayment of the actual JobKeeper. So I think keep in mind, this is trying to help businesses. It's not trying to restructure something that's just not there. And certainly, there's always a case that if you try to do it yourself, you might get it wrong. And it was an innocent mistake. And you can show that why and how you got your figures, they may be more lenient on you. So just be very careful with manipulating turnover or reporting projected income when in case where the income isn't really going to go down that far. It could be a criminal offence as well. So projected turnover is based on GST definition of supplies that are expected to take place in the month ahead. So hence why it's projected. Now you could project for a quarter, or you could project for a month. So as I say, April to June, or you could project from April. Now you've already had your March one, so you could use that as well. You actually know what that is, so you're safer, if it works for you. If you do comply, as in you can have a turnover of 30% or greater, which is very bad for business. If you've had that in March already, then you meet the criteria. But remember, your payment does not come until May. It doesn't come any sooner, and it only relates to April, not for March. Okay. So I've said that it'll be measured. Oh yeah, that's a good point. Measured on a standalone basis. So you could be a tax consolidated group, and within that tax consolidated group, you have your head entity or you have your subs. You've got all these entities in there. It'll look at a standalone. So I would go back and look at your structure, look at each company within the consolidated group, and look at it individually from a perspective of has it dropped by 30% or more or 50% or more. So aggregated turnover is the first step to work out whether you get the 30 or 50%. But once you've passed that, you look at each individual business. And I would say you'd look at each individual employer. Not all the entities within the group will be employers, but I would look at each individual employer. There's still a question mark around service entities. So consolidated groups might have an entity sitting on their own which have all the employees or a trust. There isn't anything out on that yet, so we're waiting on information on that. Also, you might be a GST grouped entity, and you might ask, do I take the whole GST group? No, looks at individual businesses. So you ignore the GST group for the purposes of doing the projected income calculation for each business. I covered off that. So turnover, when you're looking at projected, income, is turnover does not include dividends, interest, residential rent, effectively anything that is input taxed. So you would know when you look at G1 in your BAS, it has a total. Underneath that, I love this little flashy. Underneath that, it breaks it down into taxable suppliers, GST-free suppliers, and input tax suppliers. So you'd have to take the input tax suppliers out. There's probably much more in that calculation, and we've been working with our GST expert to have a look at, the best way to do that calculation. Bad debts from an earlier period can't be used to reduce your projected income. So just keep that in mind. Which employees are eligible? I'll get to the business owners in a minute as well. So which employees are eligible? You must be employed by 1 March. So a new employee that got employed tomorrow is not eligible. Currently employed, so they have to be employed If they're stood down, they're still employed. If they're being made redundant, they're not employed, but you can re-employ them. And it would apply from the time that you're eligible. So if they were an employee 1 March, you stood them down in April, say for example, and you could reinstate them for April, and you could get the JobKeeper for those particular employees. The employees can be full-time, part-time, or casuals. Casuals, it's a hard one because, as you know from the media, they didn't allow just casuals that haven't been with you for more than 12 months. So as long as a casual has been with you since 1 March 2019, probably a little bit around that, then potentially they can form part of the JobKeeper. They've got to be over the age of 16 on 1 March, so your kids can't be involved. Australian resident on 1 March, Australian resident permanent visa holder, and they're not in receipt of the JobKeeper from another employer. So, and can I just clarify, directors are also included as employees for salary and wages if they're registered under single touch payroll for salary and wages. So directors do get salary and wages, so that these conditions would apply to them. There are directors that don't get salary and wages, and I'll go through that in a minute. So not in receipt of the JobKeeper from another employer. So the employee has to nominate that they are receiving, you're the principal employer that they're going to get JobKeeper from. And that's all outlined in the ATO website under JobKeeper. So action, each employer will need to get a statement yet to be released, which is now released on the ATO website, that it must obtain from each employee confirming they qualify for the eligible requirements. So eligible employees. So once you meet, you're an eligible employer, you're entitled to the JobKeeper, you need to identify them and notify the ATO. And that's all outlined in the ATO website. The employer will also be required to notify each employee in writing that they will become the JobKeeper payment. So, you know, when I have a look at the ATO website, there's a lot of administration. Look, we can assist with all of that as well, but some of you may want to do it yourself. How do you get the payment? More important. So the ATO will shortly release further information on the mechanism of the payment, but it will likely go into your employer bank account. So action for you as an employer is to check that your bank account details are all correct. Now, how do you know? Well, you've been lodging BASs, you've been paying PYG withholding. Which account do these monies go into normally or pay through? So make sure that if something's expired, it's updated. If you've changed for some reason your business structure, that's also updated. So you have to report projections and so on by the 26th of April. And I think on the website it actually says you can start doing it from the 20th of April. So meaning reporting for the purposes that you meet your eligibility, reporting that you meet which employee is going to participate. And it's one employee all in, not you can't pick and choose who's in, but effectively one thing that you need to do is that you must pay the employee to be able to be entitled to get this payment. So the employer must be paying the amount before they can receive the JobKeeper payment. So this is where James comes in. You know, it's very important here because do you have the money in April? Now you may not have paid anyone yet because with the rules have just come out, right? So you've got a couple of days there to assess whether you're eligible. And then you've got to work out, have you got the cash flow for the month of April to make sure that you pay these employees? Todd can assist with that as well, to work out if your cash flow is there, or where can you beg and scrape from to make that payment. Then you'll get it back in the beginning of May. Now I understand the banks, if you can identify that the government is providing the JobKeeper, there'll be much more, how can I say, they'll lend you the money more willingly, a lot easier, I should say. So there's 3 scenarios which is probably best to run through. Sorry, I'm just looking down at my notes because I know I haven't got slides. It was just too hard to prepare slides so quickly. So you've got maybe three scenarios. You've got employees who continue to work with you and paid more than $1,500 a fortnight. Now remember, you've got to pay them fortnightly by the fortnightly date. They have all these days that they talk about. So the 30th of March to the 12th of April, 12th of April to the 26th. So the 12th and the 26th are the days that you would have had to make the payment to employees. Now, practically that's not going to happen, right? Because we're already on the 15th or 16th, wherever we are, of April. So they've made an exception that as long as all the payments are made by the 26th of April, and I'm sure they'll extend it to the end of April to the employees, then they should be fine. Now, how much you've got to pay? You've got to pay $1,500 a fortnight. Now, some people pay monthly, some people will pay weekly. So long as it's all squared up, you can either pay them $1,500, being $3,000 for a 4-week month, and then you pay every month you pay them 4 weeks in one hit, or you can average it out and say for the month of April it's $3,000 and a little bit more for a whole month. So it's up to the employer how they do it, so long as it's $1,500 a fortnight. Just keep that in mind. Now, I know that the fortnight falls on the 26th of April. Sorry, just distracted here. So, for April, and you've got still a couple of days before the end of April. Now, that'd count to another fortnight in the following month. So you can just carry that forward. So again, we can all be pedantic about these things, but the main thing is that you're paying the $1,500 a fortnight. Now, what happens when you who continue to work and are paid more than $1,500 a fortnight? Then you pay them as normal. Everything continues as normal. You have reporting, extra reporting, but the JobKeeper payment is retained by the employer as a subsidy towards the employee's costs. Now, remember, this JobKeeper payment is going to be assessable, but you're going to have the deduction. So employees who continue to work and are usually paid less than $1,500 a fortnight, the employer must pay the minimum of $1,500 a fortnight. So you're going to pay the minimum amount in advance. So you're going to be paying them more than you may normally pay them, but you'll get this money back. An employer who's been stood down, not currently performing any duties and being paid no wages, then you must pay them again, an employee, the full amount of $1,500 per fortnight. If the employee is already receiving Centrelink benefits, then the employer will need to inform Services Australia that they will be receipt of the JobKeeper. Now, Centrelink payments, I think, don't kick in until the 28th of April or something along those lines. So I don't think anyone would have been getting them unless, they're getting it from earlier than that. What else did I want to go through? So it will place cash flow strains on the employers. If employee resigns and terminates through any time during this payment, you have to notify the ATO. You just can't keep the payment. That'd be against the law. So I think it's the employer obligations to notify the ATO. It's the employee's obligation to make sure that they tell you that you're the principal employer getting the JobKeeper, but it's your obligation to tell the ATO if they're no longer employees. The other question was that would the $1,500 be ever used to offset any, say, payment plans or GST or anything like that? And the answer would be no. The cash boost, potentially yes, but not the JobKeeper. The JobKeeper is solely to give to employees. Okay, so whatever ATO debt you may have and you've put in place, rest assured that they're not going to take that money and pay something else. It's a very important question though. So what if you're on this call and you're a business owner and you don't take wages? Because there are business owners that take either a trust distribution, you're a sole trader, you don't get wages, you're a company and you're a director and you're actively involved in the business, but you get dividends, or you're a partner in a partnership and again, you don't get any distributions there. So what happens in those cases? Well, with a sole trader, you'll get the JobKeeper so long as your turnover test is met. So all the things we talked about, the turnover, projected turnover, applies to the business owner. That's a little bit easier, okay, because you clearly see that. With other entities, once you've indicated, you have to indicate who's going to be entitled to the JobKeeper. You need to actually be engaged in the business. So that means if you have two directors and they're both actively engaged in the business, then only one director and you have to nominate which one director is entitled to it. So for example, a company, one of the shareholders, if you've got a trust, one of the beneficiaries only, the one that's actively involved in the trust business, and a partner in the partnership. Now, you almost might be a director for many companies, so you're actually thinking, oh yeah, I can probably get this a couple of times. No, you're only entitled to the JobKeeper once. So you can't get it for salary and wages somewhere else and then get it as a shareholder of your own company. That doesn't work. You could be a company that has employees but pay yourself effectively a dividend, so you're not part of the salary and wages. That's okay. The employees get JobKeeper and you get JobKeeper, but only you or the elected person. We're getting towards the end, so good, that's good. Do you pay PYG, withholding and super on the JobKeeper? On the 1,500 that's paid fortnightly or monthly, you know, your pay cycle, basically, yes, you have to withhold if it's appropriate. So depending on the salary level of that employee. And do you have to pay super guarantee? Only on the top up. So where an employee is continuing, there's no change, there's no top up, no extra amount, you pay super and guarantee as usual. Okay, but if they're paid under that 1,500 or none of that 1,500, then you don't have to. It's a choice that the employer can make. So it's up to you. Do you have to pay payroll tax on the JobKeeper payment? Remember, it's assessable. At the present, it's not really clear. It's still to be announced, but the reality of it is there's for a lot of states, there's a lot of deferrals, and by the time that you have to reconcile your June payroll tax, we'll have the answer to that. So keep an eye out on the OSR websites. So I'd probably like to put up the poll now, if I can, before I head to the last bit of the presentation. So just on the poll, it's coming up now. I think it's important that you go to that ATO website and you just have a look at some of the things that I've discussed about checking your eligible employees from 1 March, who would apply, your projected income, you know, what do you think it looks like? Is it best to do it by month or by quarter? Look at the ATO website to what notifications you need to give to employees, what notifications you need to give to the ATO, and do a bit of a timeline and check your bank accounts.
All right, so we'll start at the top. Paul, can you clarify the conditions for which directors of not-for-profits are eligible for JobKeeper?
Yeah, so I think, Paul, I'm familiar with that question because we were talking before, but Paul, directors are employees, and I know that these directors are getting salary and wages. It's an unusual scenario because the directors get paid on a quarterly basis, but they sort of get paid so if it's January to March, they get paid in February. So I think the way the current legislation stands, and again, more is to come out because there's going to be variations, they wouldn't apply because one of the conditions is they have to have been paid. So we'll have to get some information on that from the tax office. So if you think about it, if your quarter starts on 1 April to June, and you meet all the criteria and that's all great, and there's no payment happening for these particular directors in April, it's happening in May. And so for the first payment, you wouldn't effectively be entitled because you haven't paid them. Now, the question might be, could you pay them earlier? You know,
or break it into monthly payments?
Yeah, break it into monthly payments. You could, but potentially what you pay them on a quarterly basis is quite low. So the business will have to fund the cash flow for a monthly basis. So that's something I think we need to talk to the ATO about. Wouldn't just go off changing things that you've already done.
All right, thanks, Maz. Jeff's question is, has there been any discussions for startups with no sales history, including mining companies in investment phase, whether they're eligible?
Yes, no, there was no specific example where what you're saying is there's no sales at all. So it's all funded by capital raise, I guess, equity, yeah. So there hasn't been. And
would that be one where the ATO, where you just apply and the ATO might come back to you and make a determination? Because there's going to be a lot of those determinations from the ATO, isn't there?
Yeah, look, I think what the ATO is doing, so I definitely register your interest and prepare yourself. Do all those things. What the HO is bringing out some more information on the Commissioner's discretion to use the alternative approach for certain types of entities. So it doesn't mean it'll be entity by entity basis, but it'll be a category of entity. So one in this pre-sale stage, one in a startup phase where they haven't been there for the whole year. There might have been a restructure. These are the ones that are, you know, off the cuff that we've been hearing about. So I think, Jeff, there'll be more information to come on that. And as soon as it does, we can keep a list of these queries and come back to you if you haven't seen it by then.
Anon has put in a question around JK as well. If a business chooses to pay an employee more than the subsidy, either through topping up or using their leave entitlements, or paying an agreed percentage of regular wage, which is more than the 1,500 per fortnight, is super calculator omitted on the total, i.e. $1,000 a week, or just the 250 extra on top of the JobKeeper?
Yeah, so if you've been paying them 1,000 a fortnight, say for example,
1,000 a week.
Yeah, so they work on fortnighly.
Yeah. So if it's 2,000 a fortnight compared to 1,500.
Yeah. So if you've been paying them 2,000 a fortnight, you'd pay your super guarantee on that. If you've been paying them less than that, like say 1,000 a fortnight, you have to pay 1,500. So it's only on the top up that you can choose to pay super or not. So in that case, it wasn't a top up. So yes, you do have to pay it.
From Daniel Hobbs, let's say March and April and May are on par with the prior year, but no sales in June, which means the June quarter is down 40%. Can the claim be made from 1 April, like the start of the quarter? I think that'll probably go back to the June timing.
Yeah, it'll go back to the June timing. So it'll go to, because it's more complicated than that, but eligibility looks at on a fortnightly basis. So it's when you meet the criteria in a fortnight. So if you meet it in June, it'll start from June onwards. So you won't backdate until 1 April.
Stephen Garner, if your business is residential rent, is it impossible to get JobKeeper?
Which one are you on? Sorry, what did it say?
If 100% of the business's income is residential rent, is it impossible to get JobKeeper?
Well,
depends on whether the residential rent is down, I would have thought.
Yeah, I guess the residential rent is input taxed. So if you looked at it from a GST projected turnover sales, it excludes input tax. So currently, yes, but maybe more information will come out on that.
From Daniel, using sales on BAS when GST is on a cash basis. Let's say no sales raised to clients in May and June, but clients pay outstanding invoices for Feb and March, which means sales per BAS aren't down 30%. Would they be eligible from 1 April? So where you're getting debtors paid on a cash basis would come through.
Well, it's projected on your GST turnover.
Yeah.
So whatever your sales figures would be for that period.
But if you're on cash, you're getting the previous few months debtors coming through.
Could you
not
project,
actually generate anything now?
Yeah, and I guess you'd have to look, and you could project for the April to June, and that might give you a better figure. So I think it's about looking at, it's about the numbers at the end of the day.
You might use a quarterly approach there rather than
a monthly.
Yeah. From Mike, a choice of month or quarter on turnover. Treasury website says turnover has or will likely fall in the relevant month or quarter, depending on your business activity statement reporting period. Yet the ATO says you can choose. Who is correct?
Well, look, I had a look. Sorry, Mike, are you referring to the explanatory statement?
I think that's it. Yeah.
Yeah. Look, that was one of the questions I had, and I think they're not linked. So turnover.
The ATO is supervising it anyway, so the ATO.
Yeah, that's right. So they're not linked. So you don't choose your cycle. That's what I initially thought. Your cycle would be chosen depending on what your BAS, whether you're a quarterly, lodger, or monthly. But it's actually not linked. If you go back to the explanatory statement and have a read of that. I hope that answers your question, Mike.
I think the ATO is just going to make up its own rules, and Treasury will fall in the background, right?
Yeah, I mean, I guess it depends a little bit on how big your fall is. You know, are you on the cuff or not? And that's that's how how much more attention you have to pay to the projections.
Yeah. Beneficiaries of trusts. There's a family trust with 3 separate but associated families involved, mum and dad and some sons and their families. Is only one individual eligible for JobKeeper?
Yeah, so long as it's the, remember, go back to what we were saying about beneficiaries of trust. Are you carrying on a business? Is the trust carrying on a business? And is the beneficiary an active member? And it can only be one. There can only be one. Anyway, I was looking at the Highlander movie, I think, somewhere. Sad, I know.
Yeah.
But yeah, so there can only be one of those. And I would ask whether the sons are age 16 or more at 1 March. So they would be out anyway.
Yeah. And on single touch payroll reporting, those doing a monthly payroll, do they need to change to fortnightly and transmit that data to the ATO on a fortnight instead of a monthly?
No. So look,
So
the ATO has said that you can just use a reasonable estimate. And if you're already monthly, keep
break
doing
it into
monthly.
2. So just break it into 2. Yeah.
Just keep it into monthly.
Yeah.
You know, do it the way you're doing it, but make sure that you're paying the minimum amount, being the 1,500 to those that might have been stood down and don't get anything currently.
Yep. Okay, that's all of our questions, unless there's any more.
I think Mike said no, that doesn't answer his question.
No.
Mike, I'd go back to the rules. So there's the explanatory statement. If you go back to the rules, it doesn't link the BAS.
Yep.
And I'll have another look myself, but I'm pretty sure it doesn't. So Mike said, in my trust example, sons are in their 40s. Wow, with their own families. So 6 adults seem a little unfair. Yeah, but I wonder though, Mike, if those 6 adults are working somewhere else or doing something else. Or they may be directors of their own companies that they get a dividend, so they might be able to get JobKeeper somewhere else. If they don't get it for the trust, I mean, is that possible, Mike? That's all I'm saying. So where it doesn't happen for that particular trust, they may get it elsewhere. They're not totally out.
I think you might need to call him.
Okay, Mike. Yep. I'll call you later. Sounds like a threat, doesn't it?
Yeah.
Nick, hi Nick, how are you? Just to clarify, employees paid, say 2,000. Oh, you've okay. Okay, so just to clarify, employee paid 2,000 per fortnight. Did you ask this one, SG, on 2,000
Nope,
or
just came through.
500? Does it make a difference if not working? Yeah, so if you're paying them 2,000 per fortnight, you're well over the 1,500 per fortnight. So effectively, you pay SGC as normal. If you're paying them 2,000 and they're stood down, then again, you don't have to pay the SGC on the 1,500 because no one's paying them. And again, it's the top up amount. So if you've topped it up by paying them 2,000, they're only really referring to the 1,500. That it's up to the employer whether they pay the SGC or not. So it's an add-on to what your employer would normally be paying.